Today, let's talk about one of the most fundamental concepts in investing, risk and return, and why they always come as a pair. And to make it easy to understand, I'll use something we all know: cars. Just like choosing a car, choosing investments depends on your comfort level, lifestyle, and long-term goals. So, why using cars to explain investing? Cars are actually a perfect analogy because there is no perfect car, only the one that suits your needs. You always trade speed versus safety, performance versus fuel efficiency. What feels right depends on who you are and what stage of life you're in. Investing works exactly the same way. Think about it. High-risk, high-return investment is like high-performance sports cars. They are fast, powerful, exciting, but they require more skill and carry higher accident risks. The investment equivalents include AI stocks, early-stage tech, high-growth small caps, and semiconductor momentum plays. They have the highest potential return, but also have the biggest swings and biggest emotional pressure for investors. These sport car-like investments are suitable for younger investors, people with strong cash flow, and people who can tolerate temporary losses. Next, let's talk about North America's best-selling family SUVs, the stable, reliable, and fuel-efficient Toyota RAV4 and Honda CR-V. These SUVs are definitely not the fastest, nor the most exciting, but they are extremely reliable and predictable. Some investment equivalents includes QQQ, S&P 500 ETFs, for example, VOO, SPY, and some broad, diversified portfolios. They have pros of smooth long-term ride, but there is also less surprise upside. This is the choice for long-term planners, stability-focused investors, and people who want moderate risk, moderate return. And then we have some special-purpose vehicles: pickups, hybrids, EVs, campers. Each serves a clear and specific need. For example, pickups are for towing and labor. Hybrids are for maximum fuel savings. EVs can provide short high-speed bursts but limited travel range. Lastly, campers are for people who enjoy outdoor lifestyles. Some investment equivalents are dividend stocks for income-focused investors, REITs and utilities, clean energy funds, and niche sectors like robotics, cybersecurity, biotech. They are great if they match your actual needs. Next, I need to tell you why risk and return are always linked. In every market, higher return requires taking on higher uncertainty. This rule exists because if something could give you very high return with very low risk, everyone would buy it immediately. When everyone buys the same thing, the price increases, resulting in future returns drop. Risk rises and the balance resets. It's a natural law of markets. Let's go back to our car analogy. A supercar that reaches 300 km/h consumes more energy, needs specialized parts, and has higher accident risk. A RAV4 that uses very little gas will not give you thrilling top speed. Even electric cars like Tesla, it has high acceleration, yes, but range is limited, especially at top speed. You can see there is always a trade-off, just like you cannot find the fastest car with the safest performance using the least fuel. You also cannot find the highest return with the lowest risk. Anyone promising this is either unrealistic or not honest. So here's the key takeaway. There is no perfect investment, only the perfect match for you. If someone asks, which investment gives the best risk-reward ratio? The real answer is, it depends on you. Imagine an investment that loses money for 3 years, then explodes in year 4. Is it good? If you're young, maybe yes. If you're 60 and might need the cash, absolutely not. If your cash flow is tight, also not suitable. Your life stage, responsibilities, and psychological comfort matter. You may ask, how to evaluate my own risk level? If you open an account at a bank or brokerage, they usually test your age, health, income stability, family obligations, cash flow needs, experience with market volatility, and psychological tolerance, which is very important. There are also online tests, for example, Vanguard, Schwab, Morningstar risk tests that can help you self-assess. In conclusion, risk and return always travel together. Just like choosing a car, the goal is not to chase the fastest model, but to choose one that fits your journey, your lifestyle, and your limits. When you understand your own risk tolerance clearly, you will make better decisions, stay disciplined, and build long-term wealth with far less stress. In the next episode, we'll talk about why 95% of investors lose money. It's not the market, it's emotions. Stay tuned.